The $7,000 lie. Okay, so here's something that's been bugging me for like 2 years now. You've heard of a Roth IRA, right? The retirement account everyone tells you to open in your 20s. Tax-free growth, tax-free withdrawal, basically the holy grail of personal finance. There's just one problem. The contribution limit is $7,000 a year. That's it. 7 grand. The IRS hands you the best investment vehicle in the entire tax code, and then they cap it at the price of a used Honda Civic. You sit down, you do the math, you realize that even maxing it out every single year from 22 to 65, you end up with somewhere around $1.5 million. Which sounds great until you understand that $1.5 million in 2065 buys you. What about 400 grand buys you today? Inflation just ate your retirement and you didn't even see it leave the plate. So you ask the obvious question, why is the limit so low? Why would the government create the best account in the system and then cap it at a number that barely keeps up with inflation? And the answer, when you finally find it, and I had to dig for this, Gadeka, is that the limit isn't actually low. The 7 grand limit is the low version, the retail version, the one they show on the front of the brochure. There's another version, a backdoor, technically still legal, fully sanctioned by IRS rules written into actual tax code that lets certain people put $40,000, $50,000, sometimes upwards of $200,000 per year into the exact same tax-free wrapper. Same Roth treatment, same zero tax on growth, same zero tax on withdrawal, just with the limit blown wide open. And here's the part that genuinely made me angry when I learned it. This thing has been on the books for over 20 years. It's not new. It's not exploiting some loophole that's about to be closed. It's a routine, accepted, well-documented feature of the U.S. retirement system. The reason you've never heard of it isn't that it's secret. It's that nobody whose job it is to teach you about money makes any money by teaching you about it. So they don't. I want to walk you through exactly how this works, who can use it, why nobody told you, and what the actual numbers look like. Because once you see it, the standard max your Roth at 7 grand a year advice starts to feel like someone telling you to bike to the grocery store while a fleet of Lamborghinis idles in the driveway. The 3 buckets inside your 401k pop quiz. How much can you put into a 401k per year? If you said $23,000, you're wrong. That's the answer everyone gives because it's the answer HR gives. It's not the real number. It's just the part you can see from where you're standing. Here's the actual structure. Your 401k has 3 separate buckets inside it, and almost nobody talks about more than the first one. Bucket 1 is your standard pre-tax contribution. That's the $23,000 cap most people know about, give or take a few hundred each year. Money goes in pre-tax, grows tax-deferred, taxed on withdrawal. Standard stuff. Bucket 2 is your employer match. Your company drops in some percentage of your salary on top of what you put in. The match is separate. It doesn't count toward your 23. Most people know about this one too. They just leave it on the table because they don't contribute enough to trigger the full match, which is the dumbest free money on fire move in personal finance, but that's a different video. Bucket 3 is the one nobody talks about. It's called the after-tax contribution. And here's what's wild about it. The IRS sets the total annual limit for all 3 buckets combined at $69,000 for 2024, going up to $70,000 for 2025. So if your pre-tax bucket and your match together hits a $30,000, that leaves about $40,000 of headroom in bucket 3 that you, the employee, can legally fill with your own after-tax money. And that, right there, is where the magic happens. Because the after-tax bucket is what feeds the Mega Backdoor. That $40,000 of after-tax money, the second it lands in your 401k, can be immediately converted, in some plans the very same day, into Roth money. Tax-free growth from that point forward, forever. So instead of 7 grand a year into a Roth, you're suddenly looking at 40, 50, 60 grand a year. Depending on your salary and your plan, same tax treatment, just way more of it. The catch, and there's always a catch, is that your specific 401k plan has to allow 2 things: after-tax contributions and in-plan Roth conversions. Some plans allow both, some allow neither. Most employees never even ask because they don't know the question exists. Which brings us to the next part, which is the part where I started to feel like I'd been lied to, why your HR didn't tell you. Here's a fun experiment. Next time you're at work, walk down to the HR department, find whoever handles benefits, and ask them flat out, does our 401k plan allow after-tax contributions and in-plan Roth conversions? Watch their face. Like, just watch it. There are three possible reactions. The first one is a blank stare because they have no idea what you're talking about. Most HR people only know the basics of the plan, the match formula, the vesting schedule, the contribution limit they read off the summary plan description. The deeper mechanics of the after-tax bucket are buried in the plan documents, often hundreds of pages long, that nobody on the HR side has actually read. The second reaction is they say no, either because the plan doesn't allow it or because they think it doesn't allow it, but they haven't actually checked. And here's where it gets uncomfortable. Sometimes the plan does allow it, but the HR team hasn't been trained on how to walk you through the process, so they just say no to make the conversation end. The third reaction, the rare one, is they smile and hand you a form. That's the reaction you get at Google, at Meta, at Microsoft, at Stripe, at pretty much every Silicon Valley tech company, because their employees are sharp, well-paid, and have been demanding access to this feature for years. So the plans got rewritten to allow it, the forms exist, the conversion process is one click in the portal. You see where this is going? The Mega Backdoor isn't a secret, it's a feature. It's just a feature that flows preferentially to the people who already know to ask. Tech workers ask, doctors ask, lawyers at big firms ask. Everyone else just runs their pre-tax 401k on autopilot and never finds out the room next door exists. Why doesn't anyone tell you? Because the people who would profit from teaching you don't actually exist. Financial advisors get paid by managing assets, not by teaching you how to put more money into your employer's plan where they can't manage it. Brokers don't make commissions on 401k contributions. Wall Street has zero financial incentive to spread the word. HR has no incentive either. Their job is to administer the plan as designed, not to maximize your wealth. The only people who know are the people who taught themselves, and most of them aren't on YouTube giving away the secret. The whole thing is a structural information gap, not a conspiracy, just nobody being paid to close it. And the gap costs the average person who could have used this feature somewhere between $2 and $4 million in lifetime retirement wealth from not knowing one phrase. The math when you run it. Let me just walk you through the actual numbers because the abstract version doesn't hit. The concrete version hits. Say you're 25 years old. You make $140,000 a year, which is a normal salary for a software engineer, a senior nurse, a mid-career accountant. You contribute the standard $23,000 to your pre-tax 401k. Your employer matches at 6%, which is another $8,500. So far, you've put about $31,000 into the plan, and the total IRS limit for the year is around $70,000. That leaves $39,000 of room in the after-tax bucket. You contribute that $39,000. The very next day, you convert it into Roth inside the plan. You do this every year from 25 to 65. Now compare two timelines. Person A, the one who only does the regular Roth IRA at $7,000 a year. Person B, the one who runs the Mega Backdoor at $40,000 a year on top of their regular contributions. At a conservative 7% annual return, Person A retires at 65 with about $1.5 million in their Roth IRA. Person B retires with, and this number genuinely made me sit down when I first ran it, about $11 million. All of it tax-free. All of it withdrawable without giving the IRS a single cent. $11 million versus $1.5. Same person, same job, same salary, same investment returns. The only difference is whether they filled bucket 3. Now let me steelman the other side because I want to be honest with you. The Mega Backdoor only works if you have the cash flow to actually put $40,000 a year into a retirement account after taxes. If you're stretched on your current salary, this isn't a real option. It's also not available in every plan, and there are versions of this that involve weird timing rules, after-tax basis tracking, and pro-rata rules that can mess up your tax filing if you don't do it right. So it's not magic. It's a tool. It requires the right job, the right cash flow, and the right plan. But if you check those 3 boxes, and a lot of young professionals do, they just don't know they do. You're walking past a building marked free apartment because nobody told you the door was unlocked. And speaking of doors that nobody mentions, there's another one, specifically for people who don't have a normal job at all. The solo 401k trick for freelancers. If you're a freelancer, a consultant, a creator, a one-person LLC, anything where you write your own paychecks, pay attention because the regular working population doesn't have access to what I'm about to tell you. You do. And almost none of you are using it. It's called the solo 401k, and it has the most absurd contribution limits in the entire U.S. tax code. Here's why. When you're an employee, you can only contribute as the employee. You get one bucket, 23 grand. When you're a freelancer, the IRS classifies you as both the employee and the employer of your own business, which means you get to contribute as both. As the employee, 23,000. As the employer, up to 25% of your net business income. Stack those, and the combined limit for 2024 is $69,000. Same as the regular 401k total cap, but you control all of it. But wait, it gets better. Solo 401k plans, the good ones, from places like Fidelity or My Solo 401k let you do the same after-tax mega backdoor move I just described. So if you're a high-earning freelancer making 300 grand a year as a consultant, you can theoretically dump close to $70,000 into a tax-advantaged retirement account that you fully control. You pick the investments, you pick the custodian, you pick the timing. The IRS just shrugs and says, sure, that's all legal. And the absolute mind-melting tier is this. There's a thing called a defined benefit plan, also known as a cash balance plan. It's a pension you set up for yourself. If you're a high-income freelancer over 45 years old, you can completely legally put over $200,000 per year into a defined benefit plan on top of your solo 401k, all of it tax-deductible, $200,000 per year. Sheltered from federal income tax. This is why dentists, surgeons, top-tier consultants, and successful YouTubers shovel money into these plans. Because the math at high income levels is so favorable that not doing it is leaving $50,000, $60,000, $70,000 of federal tax on the table every year. Cumulatively, across a working career, the savings push past $2 million in many cases. But here's the part nobody tells freelancers. You have to set this stuff up. It doesn't come automatically when you become self-employed. You have to find a custodian, fill out paperwork, follow the contribution deadlines, and track everything carefully. There's a learning curve. There's a small annual fee for the more complex plans. There's IRS paperwork at certain asset levels. None of it is impossible. All of it is invisible if you don't know it exists, which is exactly why most freelancers, even ones making real money, retire with the same tiny IRA balance as everyone else. Not because they didn't have access to better tools, because nobody handed them the manual. The HSA backdoor, nobody mentions. Okay, this last one might be the wildest of all because it's not even technically a retirement account. But functionally in the hands of someone who knows what they're doing, it is. And it's available to a lot more people than the Mega Backdoor 401k, the health savings account, the HSA. If your job offers a high-deductible health insurance plan, you're eligible to open one. The standard pitch is that it's a tax-advantaged account for healthcare expenses. Put money in pre-tax, pay for doctor visits, prescriptions, whatever. What they don't emphasize is what happens if you don't spend the money, because here's the catch. HSA funds, unlike FSA funds, never expire. They roll over forever. You can invest them inside the HSA in mutual funds and ETFs, just like a 401k. And when you eventually withdraw the money for qualified medical expenses, even decades later, you pay zero tax, no income tax, no capital gains tax, nothing. So here's the move. Max out your HSA every year, which is around $4,000 for an individual or about $8,000 for a family. Don't touch it. Pay your medical expenses out of pocket from your regular savings. Save every receipt. Let the HSA money sit and compound for 30, 40 years at market returns. Then, at retirement, reach back through those decades of receipts and reimburse yourself, tax-free for every single one of them. That's a triple tax-advantaged account. Tax-deductible going in, tax-free growth, tax-free withdrawal. There is no other account in the U.S. tax code that gives you all three. Not the Roth, not the traditional 401k, nothing. The HSA is, on a pure tax efficiency basis, the single best vehicle the government will ever let you touch. And once you turn 65, the rules loosen even further. After 65, you can withdraw HSA funds for any reason, not just medical, and you only pay regular income tax on the non-medical portion. Same treatment as a traditional IRA, but with the upside that medical withdrawals stay completely tax-free for life. So worst case, it acts like a 401k. Best case, it acts like a tax-free supercharged retirement account designed for the one expense category, healthcare, that retirees actually spend most of their money on. The cumulative tax savings on a maxed and invested HSA over a 40-year career, factoring in compound growth, easily exceeds $500,000. from a tool most people think is just for paying their dentist. Why none of this will be on a test step back for a second. Look at the pattern. Mega Backdoor 401k, solo 401k with employer-side contributions, defined benefit pensions for freelancers, the HSA as retirement account play. Every single one of these is legal, well-documented, used by sophisticated savers, and discussed openly in financial planning circles among people who do this for a living. And none of them got taught to you in school. None of them got mentioned at your job orientation. None of them show up in the financial literacy modules they keep promising to add to the high school curriculum. The standard advice you got: open a Roth, max it at $7,000, contribute to your 401k up to the match, is true. It's just the entry-level version of an answer that has 15 more chapters. The uncomfortable part is figuring out why, because once you see the gap clearly, you realize there's no single villain. It's not that the government is hiding these tools. They wrote the rules and put them in publicly searchable IRS publications. It's not that your employer is hiding them. Most employers don't even know what's possible inside their own plans. It's not that financial advisors are hiding them. They just don't have a business model that pays them to teach you, so they don't. The information is hidden in plain sight by the structure of who makes money on what. Nobody profits from your financial sophistication. Lots of people profit from your financial ignorance, so the gap stays open generation after generation, while a small group of people who happen to learn the words quietly stack accounts that grow to 7 and 8 figures, while the rest of the population maxes out their $7,000 Roth and wonders why the math never quite works out. I'll be honest with you, learning this stuff isn't fun. It's tax code. It's plan documents. It's forms with boring acronyms. It is not a vibe. But the gap between knowing and not knowing this one category of stuff is, conservatively, somewhere between $1 and $5 million over a working career, which makes it, hour for hour, the highest paid reading you will ever do in your entire life. The retirement system has a backdoor. It's been unlocked the whole time. The only thing standing between you and it is whether anyone ever happens to mention the word after-tax contribution before you turn 50. If this rewired anything in how you think about retirement accounts, drop a follow. There's a lot more buried in the tax code I want to walk through. And in the comments, does your job's 401k allow after-tax contributions and in-plan Roth conversions? Go ask your HR this week and tell me what they said. I genuinely want to know which companies are awake and which ones are still asleep.